Welcome to Asset TV's Index Masterclass with me, Jordaan Bainham. Today I'm joined by Jordaan, Director, Head of South Africa and Sub-Saharan Sales, S&P Dow Jones Indices, Gareth Stobie, Director at ETFSA. Welcome to you both.
Hi, Joe.
Both of you have quite different roles in the passive or index industry. So Len, I'm going to kick off with you. Can you just give us some flavor? What do you do at Dow Jones Indices and how does your role fit in the industry?
So S&P Dow Jones is an index calculation agent, essentially. We don't invest any money at all. But what we do is we calculate benchmark indices for various markets around the world. We're based in New York, but we have offices globally. And we try to create indices that represent asset classes or represent sectors of the market that investors are interested in. And then we try and sell those indices to asset managers and banks who create investment products that their clients can invest in. So essentially our role is to create indices that are relevant for the market. My specific role is to look after Sub-Saharan Africa. So I deal a lot with stock exchanges, with asset managers and with life insurance companies and banks all over the continent. And it's an exciting space.
So just giving an example, would Gareth be a client of yours as an example?
Gareth would be a client of mine, and he would be a client of mine via clients of mine as well. So,
okay.
We're quite tight.
Quite tight. Okay, Gareth.
So Jan, over the last 18 months, my career has transitioned from being very involved in building passive index funds, either in collective investment scheme format or exchange traded fund format, and running mandates for clients using actually indices often that were generated by S&P. These days, I've moved into a business called ETFSA, which stands for Exchange Traded Funds South Africa, founded by some of the veterans of the industry, Mike Brown and Arena and so forth. And we differ from a point of view that we actually run money for clients. So we advise clients on which ETFs or index funds to use. And we also build solutions that are either retirement solutions or perhaps for someone who's already in retirement looking to draw down on their savings. And our method of delivering that investment outcome is using ETFs and most of the time using ETFs that are linked to a particular index. So I'm fortunate these days sort of having seen both sides of the fence, the product creation, development side, but now actually also advising clients on which of these ETFs to use and why and how to construct the portfolio and so forth.
And I guess that's really needed today because there are just so many out there.
No, exactly. I think that's right. When Mike Brown originally started ETFSA, the idea was to promote investment into the burgeoning ETF market. In those days, there would only have been 20, 30 ETFs. Now there are over 200 ETFs. So what started as a simple Satrix 40 proposition, invest 300 Rand a month in the South African market and grow it over time, has morphed into having a complete menu of indices and ETFs and index funds that one can choose from. And now the challenge has become, well, which one does one select? So you're almost in a sense left with a similar problem to what exists in the unit trust industry, where there are hundreds and hundreds of products as to which product to buy and how and why, and what does sort of the due diligence process around that look like.
I think I read something recently that there are more ETFs now, or index tracking funds, than there are stocks.
Definitely.
So it's starting to become a little bit ridiculous.
Definitely.
But we'll get to that later. Okay, so Len, I'm going to kick off with you the first question. Can you explain the role of index calculation agents and the overall passive industry?
Yeah, sure. So I think I touched on it a little bit earlier, but essentially we calculate the indices that are representations of how the market has done, and I'll use the S&P 500 as an example just because it's probably our benchmark index. So the S&P 500 is considered to be a representation of how well the US market has done, specifically the top 500 stocks. So if the market's up 10%, the S&P 500 will be up 10%. That's typically what people refer to. As I mentioned, we don't invest any money, but what we do try to do is we try to get asset managers and banks to launch products that will give investors the same economic outcome as if they were invested in the index. So you can't go and buy an index on its own. It isn't a tangible thing. It's really just a mathematical calculation. But what we do is we sell data to asset managers and banks. They use that data to replicate the performance of the index itself, and they pass that on to their clients. So that's really what our role is, and that spans a lot of different asset classes and strategies. So it's equities, bonds, cash, then you can break down each of those asset classes into subsectors and factors and all those type of things that are becoming quite exciting. It means that we have to have our finger on the pulse of developments, what's happening in the market, particularly in local markets. So if we go, like when we came into South Africa about 10 years ago, we have a global best practice that we think is the right way to calculate indices, but often those aren't appropriate for the local market. So in South Africa, we had exchange control issues that we needed to be cognizant of, and liquidity issues. So we will often evolve as the market evolves and tailor our methodology to suit the local conditions.
Can I ask you a stupid question? Does that mean you try to create an index that's actually replicable? There's no point having all these rules if no one can actually do it. Is that what you're saying?
Correct. So our best case scenario is if we can create indices that are replicable, because you want people to be able to invest in those and to benefit from the economic performance of those indices. But the second side of indexation is where you only use the index as a measure of performance. So we calculate indices for illiquid asset classes, for example, because it gives an indication of how that market has done. People can't necessarily buy the underlying assets of that index, but at least they know how the overall market has performed.
So it's a benchmark versus an index, is what you're saying. You do both.
It's a benchmark versus a tradable index.
A tradable index, thank you.
Our best case scenario is, as I say, to have tradable indices, and we do a lot of work with exchanges and market participants around the globe to try and create an ecosystem around our indices.
So Gareth, you've worked on both sides of the industry, creating product or selling product and then now using those products. When you were dealing in this world, what were the most popular products or ETFs that you were seeing? Where was a lot of demand was coming from? Because clearly you don't want to launch an index or launch a fund if there's no demand. Is it still the S&P 500 in South Africa? As in for their global use?
Well, typically, and globally this has also been the case, is that the big benchmark indices, the beta products in inverted commas, have the most assets because users will use it to invest the core part of their portfolio. So in South Africa, that's still, say, the top 40 or the FTSE All-Share. I know it's not an S&P index, but that would be the de facto benchmark in our market. So multi-managers and investors would say, okay, I want to have representation of South African equity, therefore I'm going to use the top 40. Mm-hmm. Then they turn to their global allocation and they say, as it relates to American markets, I would like to hold the S&P 500. So they have these strategic holdings according to their strategic asset allocation. And from a product provider's perspective, you want to fill that basic need first because that's where the most assets lie. So when we were at CoreShares, we were desperate to have big beta products that the market was using, gather assets in that space first, and then over time have more niche strategies that sort of came along afterwards. So if you look at the big index ETF and passive providers, Vanguard, iShares, State Street and so forth, the bulk of their assets all sit in these big flagship indices like the S&P 500. But as time's gone on, they've sliced and diced that into sectors, factors, and so forth. And sometimes it's not the index provider who leads the conversation, it's the product provider. And they go to Len and say, we like your S&P 500, but can we have an S&P 500 that does this, this, and this? And then using the same industrial machinery and quant systems, they can then screen and actually come up with bespoke solutions as well. And when in my 10x CoreShares days, we actually did that with S&P, where we looked at the local property market, for instance, and instead of having a market cap weighted approach to listed property, we wanted a yield weighted approach to listed property. And that index didn't exist. And we went to Len and they actually developed it with us, in conjunction with us. So I think a lot of the indexing passive world now is also client-led, which is also, I think, an encouraging development and a big part of Len's business too, which I don't think you touched on.
Maybe let's touch on that now. So what do you obviously have indices that you've created and benchmarks that you've created. And so what are your clients coming to you with, like, if they don't want the simple beta products, can you give us some ideas of the conversations you're having outside the norm?
I think maybe just take a step back is how the role of asset managers has changed over time. And asset managers, 50 or 60 years ago, used to be about selecting assets that were mispriced. So you'd have a portfolio of shares, and your asset manager would try to find the stocks that they thought were going to do well over the coming period. And they may or may not have achieved some outperformance for you. It's become far more driven by economic influences rather than stock-specific influences now. So we have clients coming to us and they say, we think that this sector of the market is going to do well. So if I look at emerging industries, say electric cars, we may have clients that come to us and say, I want to take exposure to the electric car sector, but I don't really know where to start. I don't want to just go and buy Tesla or one of the other big names. I want a nice diversified basket of shares. We'll then go and do that work. We'll identify the shares that have exposure to the electric car sector. We'll chat with the client and come up with a weighting methodology, and we will calculate an index for them. Typically, we'll consult quite broadly so that the index has got a broad audience. We don't want to be too niche and too specific. But that's essentially what we're doing at the moment is talking to our clients about where they see the opportunities and how we can fulfill those opportunities for them. Because we sit on a lot of data. We sit on a lot of analytical capability, which is very expensive for an asset manager to do on their own. We cover the entire globe, so it's 20,000 listed securities. Whereas for a South African asset manager to do that kind of work is just cost prohibitive and time prohibitive. So that's really, I think, the changing role of indexation is actually almost outsourcing your data and analytical capabilities to clients and working with them to construct indices that are appropriate for them.
So Gareth, when I look at the local market, it doesn't seem to, I think you mentioned the number 200 just now.
Yeah.
Okay. There still doesn't seem to be a lot of choice to me in terms of if you're thinking out the box. And you're almost kind of playing a dangerous game here that you're becoming too active on passive. But we'll have that debate a bit later. Can you tell us at the moment what conversations you're having with index providers about things you would like them to launch that you can replicate or somebody else can replicate? Give us some ideas of things that you like itching to buy, but the product doesn't exist at the moment.
So in the exchange-traded fund space specifically, which is largely based on different indices, if you look back on the last decade, global markets have been dominated by US markets and largely by tech. So, and that's been an exciting space to invest because there's been unbelievable performance. And so you've seen a clustering of products around that. And, technology-specific ETFs, the NASDAQ kind of index, even the S&P 500, most of these global indices have got a big tech bias to it just because of how extraordinarily well those companies have done from a kind of earnings and market cap perspective. So if you're now thinking as a bit of a contrarian investor, or you're worried about the volatility in that sector, or how stretched the valuations may be in that sector, you want to be on the other side of the market and some of the boring parts of the market, potentially like utilities and consumer staple, and maybe other regions around the world that are underrepresented in, say, the All Country World Index. And there isn't as much products. So even coming back to the US S&P 500, there isn't, for instance, an S&P 500 equal weighted product in our market, which would be an interesting index to buy because obviously you're not skewed towards the mega caps. You've got a broad representation in large cap US stocks. Equally, there's not a S&P 400 index, which is the mid-cap index, or S&P 600 index, which is the small cap.
Just want to stop you there for a second. Yeah. Those indices clearly exist, but they're in the global market space. So you're saying in South Africa with rands, you can't buy it.
You can't buy it, yeah, exactly.
Is that what you mean by it? So you can't buy a feeder fund version of it. Is that what you're telling me? Sorry, I just don't understand the logic,
correct.
The terminology.
You can't buy those indices right now in any local collective investment scheme.
Either you can play them globally, but clearly, obviously.
Globally, there'd be a whole bunch of them, probably. Locally, none of the local asset managers have said, okay, we'll run a US mid-cap ETF or index fund. It doesn't exist.
Okay.
If you wanted to go and buy that strategy offshore, you're probably going to find 20 ETF providers that have launched that particular strategy. So having your money in global markets, that's different. But if you're looking here at sort of feeder fund structures, the pockets of the global opportunity set that are still missing. And it's probably the pockets that have lagged performance-wise in recent times. So value probably in a global context, as I say, other pockets of the US market. So it's a nice opportunity for Len if he could get some of the issuers to say, hey guys, why don't we take that product to market?
Okay, but again, it's a feeder fund structure. We're talking about a RAND-based product
Yes.
based on a global index.
Correct.
But it's not here in South Africa as we speak. You can take your dollars offshore and do it easily, but not with your rands.
Yeah.
Okay, but that's not global. Is there any kind of SA products, SA-specific sectors you're thinking about? Or is our market just too small? Is it already been well mined?
It's from an index perspective, it's been very well mined in the equity space. In the fixed income space, far less so, because in fixed income, you can only really have big government bond indices, either fixed rate government bonds or inflation-linked government bonds. There aren't indices that try to index all the corporate credit and bank credit that's out there, because it's not really replicable. You basically can't do it. You'd struggle to do it. So when we're constructing portfolios, we tend to use index-based products for our equity allocation because we feel like there's enough representation and different ways of doing it through an index format. When it comes to fixed income, we actually default back to active strategies because big active fixed income managers are able to be more dynamic with how they allocate money in the market. It's not referenced to an index. There's more flexibility.
Well, those markets are also pretty liquid, but isn't it also true that fixed income active has been able to keep its place because its fees are quite low? Because one of the large benefits of index investing is obviously the fee argument. You know, you're not paying a lot of money for it. But fixed income guys don't generally charge a lot for fees. There isn't that compared to equities. Would that also be a reason that apart from the fact that these things don't trade very often and they're pretty illiquid, and from my experience, most fixed income indices hold too much of the stuff you don't actually want. That's why an active manager says, I'm going to underweight the guy who owes the most money. Or is there much more to it than that?
No, I think everything that you've said is correct. And depending on who you speak to, they may give more or less weight to the fee aspect, or more or less weight to the index, the investment case part. Interestingly, when South Africa's ETF market broke open from a point of view that you could suddenly have active mandates available in ETF format, the first products that came into market were all fixed income products, precisely because of that additional flexibility that was suddenly afforded to ETF providers to have a more dynamic income product to market. And they were reasonably priced, or are reasonably priced. I don't think they're any cheaper than what the traditional CIS version of it looks like, but it's now available on exchange as a product.
So then just we're kind of sticking to this for a second, but why would somebody who's been in the active space launch an ETF? If it's arguably the same product with the same fee structure, is it about finding a new market? Is that what it partly? So stockbrokers can now buy it as opposed to IFAs buying it. What's the thinking behind it? Because it's, apart from the fact you can trade it all day, can't you?
Yeah.
But I mean, if an IFA listening to this is trading all day, please be very careful with your clients. That's all I'm saying.
Yeah.
But I just want to understand that.
Interestingly, Jack Bogle, who was the father of indexing, he hated the idea of an ETF because he said, well, why would you ever buy the S&P 500 in the morning and sell it in the afternoon? He hated the idea, basically. Yeah. But having said that, having these products on market mean that you are opening it up to a whole range of things. So for instance, any fintech application or any platform application that's trying to come to market or is in the market, like Ease Equities, for instance, even our own platform, they can simply buy that ETF on market as a security, simple, boom, into their custodian account. They don't have to open up an account with a LISP or with the Manco specifically. So your route to access of that particular security strategy is quicker, easier, faster, more transparent, well-regulated, all that sort of stuff. So that's kind of the one angle. The other is potentially more distribution. But that's fraught maybe with some difficulty because our market is very well catered for in the CIS space. So distribution is quite, highly contested in all different formats. So it's not like a simple thing where if you go into the ETF space, you're suddenly going to open up more distribution, I don't think.
So fintech is a word you threw in there a few seconds ago. The word we haven't talked about yet, Len, is AI. Back to your business. And what's happening in the AI space, like technological innovations, natural language and processing, all these big buzzwords that we're hearing at the moment.
So
how is that helping your business?
I just want to go back to your previous question because I realized that I took a step back and then didn't actually answer your question. So what we're seeing offshore, and certainly not locally yet, is AI. So investors are wanting to take exposure to companies that either offer AI as a service or are adopting AI in their business processes. So that's one that's gaining traction offshore. The other, as Gareth kind of hinted at, is S&P 500 equal weight as opposed to the S&P 500 market cap. From an AI perspective, it definitely is having a massive impact on our business. The reason for that, I think, is that there's so much more data available. 50 years ago, there was a couple of Russian and US satellites flying around. Now you've got private companies flying satellites, taking photographs of oil fields and all those kind of things. And they're kind of commoditizing that data space that was previously inaccessible to investors. So there's these huge data sets. And then at the same time, there's been a huge development in terms of how that data can be analyzed. So we are looking at different concepts now, working with AI specialists in terms of how to take the kind of research that they're doing, the kind of data that they're producing, and incorporating it into index construction globally and in the US. So there's two angles to it. As I said, AI, people wanting to get exposure to it, so we're offering indices that allow them to access those markets. And then secondly, we're incorporating AI into our index development process. Still early stages, but as these things move quite quickly, I would imagine by the end of the year, we'll have something up and running in the US.
Okay, so again, you're seeing a demand for these indices, and you're creating indices around it because you're seeing it, the market's looking for it and people coming to you. In our markets, back to you talked about, we haven't even got an equal weighted S&P 500 yet. We seem a little bit behind the curve, okay? Are we going to be bringing in, or do we already have AI thematic funds that we can invest in?
Yeah, well, the short answer is that if you're wanting exposure to the AI world, our answer to clients would be that the companies that are probably taking the most advantage of AI are the mega cap stocks that are dominating the world, right? So NVIDIA and Microsoft and others are global leaders in AI. So
what happened to the picks and shovels argument? These guys of the starting, but you want to be behind.
Yeah, but your I think the beauty of indices is that you don't have single stock risk selection. That's what appeals to me, is that if you like the idea of AI, you don't have to go look for the cherry pick one or two stocks. You buy a broad index, either a sector index or a thematic index, or even, quite frankly, the NASDAQ, that's giving you broad exposure to this investment theme, if you want to call it a theme. And you're not going to blow yourself up by having a bad egg because you're holding a whole index. So the worst that can happen is a share that, I don't know, is 3% of the index. Who was that compliance tech stock that had the disaster? CrowdStrike, or what was that company that had that data breach a few months ago and lost half?
Yes,
CrowdStrike.
Yeah, that's right, it was.
Yeah. And so they would be sitting in some of these big indices, but you wouldn't have felt it as an investor. But if you try to be smart and select a narrow portfolio of stocks, you might well have held that share, and then you would have felt the full veracity of that selection choice. So that's the beauty of indices, of ETFs, is that you immediately diversify.
Okay, but now you've opened a door, Gareth, and it's quite a big door. All right, the second you go away from just the simple S&P 500 or the MSCI world, and you yourself talked about earlier about looking for value or being underweight the US, you're making a very active decision. You're moving away from everything that passive was supposed to stand for in the very beginning, which was efficient markets. I'm not good enough to pick a stock, therefore I buy the market. The second I start slicing and dicing all these markets, I'm no different to a stock picker who's saying I want to be overweight something else. I mean, it's a nuance, but if I go underweight the US and MSCI world, I'm taking a very active decision. I've moved away from the passive argument.
Yeah.
Please explain how that all fits in.
Well,
either one of you are welcome to answer this question, because if I understand efficient market theory and why passive started, and back to Bogle that you referenced earlier, his argument was we can't outperform the markets, therefore buy beta.
Yeah.
You're now doing active beta.
Bogle was an American capitalist. He funny enough, hardly even used to talk about international markets or other markets outside of his home domain. When you sit in South Africa, from a client perspective, you've got to match an asset allocation and a goal for that client. So the goal is income or growth. You're an advisor yourself, so you know that. And so typically in South Africa, you would say, well, I'm going to match a client who's looking for high growth with a portfolio that's got a high percentage of growth assets in it, equity indices or property indices in it. And which of those property or equity indices do I think are going to best match the long-term growth objective? And in South Africa, that's typically a blend of South African equities and global equities. And then you're quite right. You've got to have a good reason for why you're moving away from, say, the capped all share index for local equities and the all country world index and global index. But we do see advantages of moving away subtly in both instances, depending on which sector we feel that there's value or regionally where there might be value. So if the US market is trading at a PE that's way higher than the rest of global markets, well, maybe we just want to downweight it slightly in favor of the other markets. And by doing that, all you're doing is improving diversification for a client's account, and hopefully improving prospects of meeting their goal by doing that. And sometimes you get it right, and sometimes you get it wrong, but that would be the thinking. Yeah.
I think there is, to touch on what Gareth mentioned, there is definitely a change in investors' mindset in terms of 30 years ago, Americans used to invest in America, South Africans invested in South Africa. You're going to live here your whole life and retire here. So you needed your investment to grow with the economy, with the local economy. The mindset of investors now is far more global. ETFs has facilitated that to a large extent. So Americans are now taking more allocation to countries outside of America or markets outside of America. And South Africans, equivalently, they don't see themselves as South African investors. They compare themselves or see themselves as global investors. And they want to have the same sort of tech allocation as you would in a global index. And you can't buy those kind of shares on the South African market, that we just fundamentally underweight them. So I think there is a change in the availability or the ability to invest offshore, which has driven some of this stuff, and also the fact that you're comparing yourself to global investors now rather than just local investors.
Look, I love the fact we have more choice. I guess where I'm coming from is it's this whole argument of the reason passives were created was because people said, we don't want to take off benchmark risk. We want to just get Peter. But as the industry's evolved, and fantastic that it's evolved, because there's so much more choice for clients now, to your point, Gareth, I'm saying it's moving away from what it started off doing, and which is, all industries evolve, and that's a good thing. So Len, let's go back to your business again. What do you think the big risks are that you see in your business at the moment, and how you construct portfolios and how you think about these things? How do you think about risk?
Well, I mean, so that's quite an interesting point. I mean, diversification is obviously always a starting point when it comes to managing risk. So when we construct indices, we generally try to offer as much diversification as possible without diluting the actual flavor of the index, excuse me, that you're trying to offer. So we sit with clients to try and understand what their risk tolerance is. I think as an index house, we need to be extremely responsive to how fast this world moves. Indices take a relatively long time from start to finish to put together because of the regulatory hoops that we need to jump through. And you don't want to miss out on evolving trends because it's taking you that long. So we are bringing down the time that it takes to develop products. And we're also opening up the analytical technology and the data that we have to clients to be able to do their own analysis. So they aren't going to be hamstrung by any bottlenecks we may have in our internal processes. So these kind of things we have to be very responsive to. I suppose the other risk is that we can't always see what the future holds. And
nobody can then.
No, nobody can.
Nobody can do that.
Yeah. So we need to really keep our finger on the pulse of developments. They happen much quicker than they did a few years ago, and we need to stay on top of that.
I like the word you used, that data. And I think you said in the very beginning, you kind of sell your data to the people who create the indices around it. Do you get that data and put AI on top of it and then use that to make other decisions in your portfolios? Is that something that's happening yet in South Africa? We're not quite there yet.
We don't. I'm sure some of the asset managers in our markets are heading that way or have headed that way. Someone once put it to me very philosophically as the whole construct of a market is a form of AI, which I thought was quite profound in that it is, because it's got multiple participants who are constantly working away at it until there's a real value there. So it's kind of, there's already an AI organism in a sense.
The collective.
We don't in our business. We are looking at it from maybe a servicing perspective, but not in part of our investment process.
We definitely do have clients that do that. So they call it enhanced indexation, where the majority of your portfolio is invested in the index securities in their proportions, and then you up or down weight particular securities in that portfolio according to your own analysis and view.
And using that data.
Yeah.
Okay, so let's back to South Africa, because I'll come back to quite a few things, Gareth, you and I spoke about before. The harmonisation of the JSE, those are big words. What did that mean exactly? It happened last year, didn't it?
It did. April, I think, was the...
Just in layman's terms, can you explain to us what happened?
Okay, well, perhaps the simplest way of understanding it is to take a step back and appreciate our corporate history, where a lot of large South African companies became global companies, Anglo-American, Richemont and others, British American Tobacco, that had strong South African roots, but became global businesses and had multiple listings. And often those listings were not actually, the main listing actually wasn't often in South Africa, it was in London or elsewhere. But because of this history, ISA managers all had heavy weightings towards those stocks. But those stocks also popped up in other global indices all over the show. And so through time, we then developed, normal indices that have those shares at their normal kind of global weight, and then we're going to have shareholder-weighted indices, which is based on what percentage of that company's shares trade here in our market, because that brings more relevance.
It's to do with the float, really. How much of it float trades here?
So a company like Anglo-American, it's going to have some of its float here in South Africa and some in London, for argument's sake. So we're going to look rather at its a local float. And for a long time, we ran these kind of dual benchmarks, dual indices, but now everything's been consolidated onto a shareholder-weighted basis. So all of the indices are now premised on how much of that share is owned locally by local South Africans, which means a share like Anglo-American, to keep using them as an example, would have been massively downweighted in the index because you're stripping out other markets. So that's now, I think, simplified things, because if you look at a local index, you're looking at really the South African opportunity set. Albeit that some index providers still strip out those shares from the South African market to say, well, they're not South African.
That's the MSCI World SA, isn't it? Does that?
As an example, yes. So, but Len could probably build an index tomorrow like that as well if you want.
We actually do. We do have, because we deal with global investors. So we're running 3 different series on South Africa. We had the one that stripped out the dual listeds. We had the one that used entire global market cap. And then we ran one for the domestic shareholder weighting, we called it. What's happened is we've collapsed the domestic shareholder weighting, but we've incorporated the domestic shareholder weighting into our standard indices now. So you're now down weighting the Anglo-Americans and those kind of stocks. And that's actually the global standard. That's how everyone else did it. South Africa had this difference because the companies that went and re-domiciled had to get permission from the Reserve Bank to do that and had to get specific exemptions. So it has simplified things for us.
Okay, but now let devil's advocate, okay? So I'm running a client portfolio. I've got to my max 45% offshore. I don't want the index I bought to downweight my Richemont and Anglos, because I kind of want a larger offshore weighting. Yes. So what do I do now? Because the index that the ETF I used to buy that used to replicate the JSE has changed its rules about what the weightings are to these offshore companies. How do I go and buy something now that goes back to the old weightings?
Well, you can go to Len, who could build you an index that upweighted those again, or just had dual weighted.
But is there a product for that?
I don't think
there is a product for that.
Is the Satrix JSE Global Equity Index? Is that not the one that does it?
That's precisely the one, actually.
Sorry, thank you. Yeah. Doesn't that do that?
It does do that.
So remind everyone in the audience, like, what does it do? Does it go back to the normal weights that doesn't matter about shareholding?
No, it goes beyond that. It looks at, and I stand to be corrected here, but it just looks at companies that are dual listed. So it wants to deliberately
Oh, is it only?
Upweights
Oh,
that.
okay.
Yeah.
So it just buys the rand hedges,
Correct,
basically.
correct.
Is that okay?
Yeah. But so maybe we still are overcomplicating it. I think maybe one way of looking at it is
Yes.
if you're sitting in America and you want to make a South African allocation, you want it to be a pure South African allocation, not a South African allocation that includes Richmond and Anglos, because you're holding that in your
Yes,
European
got it.
European thing. Whereas South Africans, we've got a more complex worldview because of Reg
28
and
yes.
because of our corporate history and
Yes.
large holdings and weightings in these stocks.
So it depends which hat you're wearing
Absolutely.
as to which product you're buying.
Yeah.
Okay. Looking at the industry generally, Len, is there anything we haven't talked about today that you think we should be talking about in terms of your markets and your business?
Yes, I think the one thing that we touched on slightly was the indices on unlisted assets or
Oh yes,
illiquid
we haven't
assets.
even got to private debt or private equity. Let's talk about that now.
Correct, Josh. So S&P acquired the capability to calculate private equity indices, which again are not replicable because a lot of those projects are closed for investment, but they do give people an indication of how that asset class has performed. And then we're also able to take specific private equity projects and replicate the cash flows of that project, but assume that your underlying investment is an index, an equity index, so that you can deduce what the IRR of a public investment would have been.
Yes,
because a lot of people are saying, I've got my equity allocation, that's where my private equity investment is going to come from. At the end of the day, I want to see whether that was a good move or a bad move. So I need to be able to make a comparison in terms of the performance. And obviously, private equity is valued quite differently from listed equity. So that's something that we're doing quite a lot of, mostly in Europe. We're trying to get enough data points in South Africa to make it more relevant because it relies on the private equity projects to actually submit their data to us.
There's another one that I'm interested in. Because of rules around alternative investing in South Africa, let's take it out of private equity, private debt, but hedge funds, okay? And if you could launch an ETF on hedge funds globally in South Africa, that we could still fit, because it would be UCIT structure, not UCIT's a unit trust structure. Gareth, maybe I could bring you in here, that I could actually invest in offshore hedge funds through a locally listed rand hedge. Do you understand? You're taking private debt and you're making it accessible to the retail public in what you're talking about in a sense, no?
No, not at all. So because these aren't replicable, you can't invest in these things.
You can't invest, okay.
No.
Absolutely sure you can't invest in them. But are we seeing other products that can make illiquid assets investable, Gareth?
We are. So I mean, I've gone blank on its name, but already now there is a note in our market, AMC in our market, that buys US listed private credit shares. So these are big private credit managers in the US.
But these are listed companies, you're buying their shares.
Correct.
You're not buying the underlying private equity though.
No, but their core activity is to manage private
yes.
equity. So it's a type of quasi or hybrid holding into that type of exposure. So I think the efforts to get there. But the whole idea of private equity or private debt is that it's uncorrelated, unliquid.
It's uncorrelated because it doesn't price.
Yeah.
I'm not sure it isn't uncorrelated, just everyone thinks it isn't.
Exactly.
It's a different argument. But
exactly.
Just want to get back to what Len was talking about, this sort of private debt world of private equity. Are there any other, where have you seen the most of the flows? Because I don't even think I've asked you today, where have most of the flows gone into the funds in South Africa? Is it still S&P 500 trackers or is it people waking up to gold?
So gold has seen in the ETF space a lot of flow this year because it's been a big global investment theme as volatility has risen globally and record gold price and that. So our big gold ETFs, OneVest and who's the other provider? I've gone.
Standard Bank.
Standard Bank.
Oh, sorry.
Standard Bank is one, ABSA, of course, New Gold. Have both seen big flows. And then the traditional beta products, because as I say, those are still forming the core part of client mandates. So every time a big client mandate receives inflows, those core beta allocations will still dominate the flow. And then some of these smaller products will follow after that. Yeah.
Gentlemen, thank you so much. It's been awesome having you two on today. Thank you.
Lovely. Thanks, Joe.